So hello again, good afternoon. We are here at the crypto trading floor, which is a very apt name for this panel. We've heard a lot about crypto as an idea, as an opportunity, and in this panel we are meant to dig deeper and understand better how trading crypto works, both for the retail side, the institutional side, and no less important for the retail broker space. So leading us through these waters will be Monica Summerville, head of fintech research at Tabb Group, an all but important think tank. So you can have your seat or stand. Okay, so she'll be standing. So put your hands together for this distinguished panel, and I wish you a fruitful discussion. Remember, you can submit your questions. Thank you.
Hello, everyone. Just so I can watch the time as well. Yeah, so I think with this session, we're going to try to bring things back down to a reality level. We've heard some really exciting speakers, hopefully getting everyone excited about crypto. We have a really good panel that come from a broad range of infrastructure providers. So just to kick things off, I'd like each panelist to introduce themselves and introduce their company briefly and just talk about where in the market they sit and what kind of services they offer. So Sam, if we could kick that off with you.
Sure. I'm Sam Teagle with CTX. We're an institutional-only exchange based in Chicago. We are basically bringing regulation, operations, market structure, and the tech stack that you would recognize from traditional asset classes into the crypto space. We're a team of about 40 people. It's a venture-backed company. We recently finished our Series B with Bain Capital as the lead investor. And we're launching right now on the spot side, and we'll have derivatives coming in Q1, all in a fully regulated stack.
Hey everybody, my name is Daniel Skowronski from DX Exchange. We are a crypto P2P exchange. We're mostly well known for our partnership with NASDAQ, where we utilize their matching engine technology, the first in the crypto space to do that. We're regulated in the EU under Estonian regulation. We also have a pending MTF license in Cyprus. We'll be launching also a security token exchange in Q2 of 2019, so we'll both have the utility and the security token exchange.
Hello, my name is Obi Nwosu. I'm the CEO and co-founder of CoinFloor. We are a group of cryptocurrency exchanges for institutional and high-end retail investors and traders. We, as I said, we are a group. Our most well-known is CoinFloor Exchange UK, which is the longest established cryptocurrency exchange in the UK. And we also have CoinFloor Exchange Gibraltar, which is the first regulated exchange in Gibraltar under the DLT provider framework. Further, we also have the first physically delivered cryptocurrency futures exchange, CoinFloor X, which is based outside of Europe.
And hi, my name is Philip Gillespie. I'm the CEO of B2C2's Japan office. B2C2 is one of the largest electronic liquidity provider in the OTC space in crypto. We're headquartered in London. We have around 30, 40 people in our office here, mostly from traditional finance background. And one of our focuses has been to bring in the expertise in traditional finance into the crypto space. And that's what we aim to do. So.
Okay, so Philip, we're just going to stay with you for the next question. And after Philip speaks, maybe all the panelists can jump in with their views. But if you could just give us your take on where the market is right now in terms of the split between retail and institutional flow. You know, it's an interesting asset class because it really started in the retail space. Institutions have been a little bit late to the game. You know, what are you seeing and where do you see it going?
Yeah, I mean, I really think there's this weird kind of overhype, right? You know, when CME first decided to start offering having a crypto offering, everyone's like, oh, this is a moment. This is a moment. It's going to be all institutions coming in, and it wasn't. And I think you know, right now the market is still dominated by retail. But one thing that I can say is, you know, like myself, I left Goldman Sachs earlier this year to join crypto, and there's around 17 or 18 people who have left Goldman in 2018, believe it or not, to come into crypto. And what I think is happening in 2018 is you're kind of laying out the groundwork. You're having, if you could take a snapshot of people involved in crypto, 2015, 16, 17, 18, and you kind of see like their background. I think this is the year when a lot of traditional finance came into the crypto world. And I think this is a very important kind of evolution of this asset class. So it's still dominated by retail in terms of volumes, but I think the groundwork is getting laid out, and I think that's a very important part of this whole evolution of this asset class. And I think that all we're waiting for really is a catalyst for volumes to pick up, and when it does, all the processes involved in KYC, AML, the infrastructure, and everything else is going to look a lot more familiar to the traditional finance guys, and that's when we're going to start seeing the pickup. My personal opinion.
Sam, I know you're ex-Jump. I don't know if you mentioned that in your brief intro, but what do you see?
No, but I'll echo that on terms of the personnel. I spent 15 years as a HFT market maker with firms like Sun and Jump, working in equities, FX, treasuries, futures, so across the board. And at Seed, our founders are startup guys, but most of the management team is from places like CME and Jump and Fidessa. And so I mentioned our team of about 40, mostly from traditional finance in Chicago. So I think that you see that in terms of the types of people in the space and the normalization of the technology and the processes. But I agree also that there hasn't been a catalyst for institutional trading, to push them over the hump, especially with low volatility right now. But a lot more of the pieces are in place now. We're representing the exchange side, but there's also work being done on the custodian side and the prime brokerage side and the kind of asset management side too, which is equally important, I think.
I think just to weigh in a little bit. Yeah, the market was led by the retail space. There's no doubt about that. But I think you also have to define what does institutional really mean. Because when you look at today's market, you can look at the exchanges on CoinMarketCap and you can see that the volumes of where they're at. But let's say one exchange is doing $1 billion, but I can guarantee you off on the OTC market where there is institutional guys like Philippe is doing, or some of the, Circle, or some of these other guys, there's a ton of volume that's going on Skype and on Telegram groups and everything else. And we would kind of classify that also as institutional liquidity, because it's not, individuals necessarily trading it, but it's a lot of these big, medium-sized institutional players. Now, if you're talking the Goldman Sachs of the world and some of the banks getting involved, yeah, we need some definitely bigger movement coming into the space.
Yeah, so having the lens of time, being in the space for 5 years, you have seen a massive transition. 5 years ago, it was 100% retail. But actually, as long as 4 years ago, we started seeing institutional players enter the market. But as Daniel says, it depends on how you define institutional. We classify institutional on the range in terms of their risk appetite. So you have the risk averse to the risk tolerant. And 4 years ago or more, the risk tolerant were already entering the market. They could have been people who were playing with their own book, for example, proprietary trading firms, etc. But over time, we're seeing more and more risk averse getting into the market. But to the point where the most risk averse, some of the largest financial institutions enter the market, will probably be a long time from now. Although they are at this point in time investigating very heavily behind the scenes.
So given that, I mean, it's true that the flow is still, it's predominantly retail, but I think it's fair to say that a lot of that retail interest has fallen away this year. So given that it's going to take a while to get the big institutions in, what's going to happen in the meantime to entice the retail, get them more excited, get them excited to come back into the crypto space?
Well, as Bane from Batman Begins would say to Batman that you live in the darkness, but we were born in the darkness. So when we launched, it was another very competitive period, a very bearish period. And what we found was that in that period, in periods that are very bullish, it's like hungry hippos where money's falling from the sky and you just collect as much as possible. But in a bearish period, you need to make decisive decisions and focus on capturing market share from other people. And that means going back to your core customer set, and understanding there's a 3 or 4 classifications of customers who buy in this market. So there are traders, and they can be in various forms, market makers, through to arbitragers and straight traders. There are investors and really the focused long-term view investors who have large pockets, so the high-end, high net worth, etc. And finally, there are brokers who are people who collect a number of the maybe smaller traders together. And some of those markets do very well in the bearish period, and we just focus on those. I won't say which ones they are, but you focus on those and capture market share from other people?
I think from the pure retail side, how do we get those people to get more engaged is, you know, look, at DX, when we looked at what happened in 2017, which was this massive just growth of crypto, just go get as much market share as you can, do anything you can, regulated, not regulated, it didn't matter, right? And people were just buying it up. As you say, I love this hungry hippos analogy. But look, for us, what we found is that the average retail person, they do want to still get into crypto, but what their biggest fear is, they're not going to get their money back out. They don't know whether their bank's going to accept it. They don't know. They don't want to go to some Asian exchange, perhaps. It's very foreign for them. The process for somebody to get into the space was very difficult, and still in some cases it is today. So, you know, at least for us at DX, what we're doing is we're trying to create a better ecosystem where we're partnering with the right institutions. We're going with the right regulation. We're making the average retail person more comfortable that they know that they come in with fiat, they can trade their crypto, they can come then exchange it and then go back out with fiat, and the bank will like it, the regulators will like it because they can follow the money trail. So I think that's going to help bring back into the retail trader. The other thing is getting rid of all the mess of all the ICOs that were out there. There is a lot of garbage, as you all know, out there. And today, again, it's about being responsible on the exchanges to not just list everything that comes your way, but to actually list really good projects so that the clients actually have something really worthwhile to come back for as well.
Yeah, I have something to add for him. I mean, obviously we're in London right now, and we're maybe predominantly focused on the European and US markets, but I was in Japan, and you can imagine I just moved to Tokyo earlier in January, and then advertisements everywhere, right? You take a cab, you turn on the TV, buy Bitcoin, et cetera, then CoinCheck happened, and you can imagine it's just all gone. And this might be interesting insight, but one thing is a whole systematic kind of factor. What's going to be the trigger globally for everyone to get interested? But one thing that I could say in a market like Japan, which is a very big market for trading crypto, we're starting to see the commercials coming back. We're starting to see not only are you seeing some of the commercials and the interest coming back, you're starting to see very large participants coming in. And these guys were already looking to participate in crypto from earlier this year. They haven't been able to generate any revenue because the FSA and the regulators said, let's take a pause. And what the regulator has ended up doing is saying, hey, you know what? We need to add some professionalism into this market, and then, we're ready to start up the business. And this might be interesting to look at what happens in the next 3 to 4 months, because you had a massive hack, and now you're going to start having the marketing effort and everything else picking up. I personally think that the volumes will start picking up. I know it's just one market, but it's a good example of what's happening across different parts of the world, and a bit of an idiosyncratic story on how we might start seeing some pickup in one section of the market.
So if we've talked a bit now about getting the retail investors sort of excited again, but let's just going back to basics, what really, in terms of the services you need to provide, how does it differentiate between what a retail customer will want from an exchange versus what an institutional customer will want for an exchange? I don't know, Sam, do you want to? I know that you're institutional really focused, so maybe we'll start there.
Yeah, I mean, the way we think about it is we're going to have 300 clients, not 3 million clients, and so everything is kind of built a different way when you're building that way. So a lot of the folks that we speak to are excited to have just traditional institutional account coverage and pick up the phone when we call and simple things like that. I think the retail businesses are great businesses, but they're just built for scale, for a different type of scale, for a different type of customer. And for institutional folks, they have different expectations on the technology side and on the kind of operational side as well.
And just to clarify, when we say institutional, as Dan mentioned, how do we define institutional?
Sure.
So is it anything from family office sort of up? Or?
Specifically on the CEF side, participants have to be a ECP, which is a CFDC term for eligible contract participant, a certain amount of assets. And on the spot side, this is the same thing where we require a certain amount of assets. So institutions, it's not individuals. That's how we define it anyway.
So it includes sophisticated investors.
Yes, it
in
includes
that sense.
sophisticated investors, it's market makers, and then the whole range of institutional traders that might be miners or hedge funds or asset managers, et cetera.
Okay, so you're talking about the customer service they expect. How about sort of market order types, things like that?
Yeah, it's traditional. We have a different market structure. We have like bigger minimum sizes than the retail platforms. We have like $5 wide spread and one Bitcoin minimum, for example, because we think that people are trying to move meaningful sizes. that works better for them, and it appeals to the market making community as well. And then on the technology side, it's all fixed, very familiar technology, familiar connectivity. We're co-loaded in NY4, and so it's a kind of familiar workflows for the market makers as well as the asset manager and hedge fund types that are used to trading in that manner.
Just a quick question for the exchanges that are represented here. Do you all support FIX? Yes?
Yeah, we have FIX APIs, we have REST APIs. There's one more too.
WebSocket.
Which one?
WebSocket, maybe?
Yes, WebSocket as well. Yeah, we support all three.
Yeah. And do you certify your vendors that connect to you via FIX? Do you know? No, don't worry.
Actually, I'll save that for our CTO. The one thing I do want to point out on the institutional side, one thing I think that we have personally seen is a number of asset management firms now reaching out to us, or family offices reaching out to us, that now they can purchase crypto because of the type of regulation that we do have. In the past, I think there's been certain exchanges out there who maybe didn't have that particular regulation that they needed at a certain level or a certain quality, so that prevented them from entering the space. So that's one thing, like for us, that was mostly around the asset management and family office. I think the other thing on the retail side, to answer your question on what I think what they're looking for, I actually believe there's a lot of fatigue in the market right now around the existing exchanges. People are a bit tired of seeing the same names and the same things and the same movements that's kind of going on. And I think if you looked at the CoinMarketCap, the top 10 exchanges 6 months ago and 6 months prior to that, there's always this constant shifting. And I think there's going to be a new wave of new exchanges that are going to be coming in, which are the more regulated ones, people that are more comfortable to put their money into, so that we can get, because everyone got burned over the last 9 months. And I think people really do want to be in this space and they want to support it, but I think they need something different right now. They need to kind of get rid of that bad taste with something fresh and new.
So I think in terms of the difference between retail and institutional, retail ultimately wants the most convenience, easiest to use system, and they're maybe not cognizant of the risks they're taking by wanting that need. And they're also not necessarily cognizant of the cost they're paying, because they tend to pay over the odds. So if you're focused 100% on retail, you just make sure it looks good, it seems good, and you can do very bad things with the customers in terms of the revenue you can make. Now, what retail needs is the influx of institutional investors and traders, because investors and traders are looking for, over convenience, they want quality. They want to make sure spreads are tight, service is reliable, they gain confidence from processes that reduce risk for them, including having appropriate regulation in place. As they come on into the space, they also help stabilize the price, they increase trade volumes, and that in turn benefits of retail. But retail doesn't see that, and until institutional players are in the space in force, there's always going to continue to be a risk for retail.
I just want to add on that, because I think it's a great point. I was speaking in the World CryptoCon 2 weeks ago, and there was the panel that I was on was about liquidity, and it was about market makers and where they're trading and everything's going on. And it seems like everybody's kind of going back to one particular exchange because that's where the liquidity is. And I think the challenge that's going to be out there from the institutional space also getting in there is they're usually just chasing the liquidity as well, which is important right now. So we sort of get stuck with this other type of technology. So I'm kind of interested to see how that's going to be broken.
Yeah.
Just to finish, and you sort of stole the thunder a bit, which is great. I'm completely fine with that. But in terms of liquidity, institutional players, they're sort of stuck in this quandary, because ultimately they like trading against retail clients for the same reason that some exchanges like focusing on retail clients, because it's easy for them to make profits from that. So we're going through this, and it's going to continue, this painful transition, but for some people a very profitable transition, where we're going to see this increase in institutional demand and in relative terms, a decrease in retail demand. And how long that lasts, it depends on how long it takes for the majority of the world, I believe, to have appropriate regulation in place. We're seeing it starting. We're regulating Gibraltar, Japan, etc. But you need to have the majority of trade volume being traded on regulated platforms for us to fully see the transition. And that, based on conversations we have with various regulators around the world, could take a while still, I mean, measured in years.
A couple thoughts on liquidity and the retail piece too. So it's a good point about the market makers like trading against retail, but if there is a heavy dose of institutional market maker flow, that is also attractive to market makers. So as an institutional only market, that is a challenge for us, is to get enough institutions on that our market makers have a good experience. But in terms of the liquidity problem, I think the biggest issue is just the capital inefficiency of the space and how market makers have to park money everywhere, and why this whole chasing game happens is because the cash is captive to all these exchanges. So we have a custody solution, and that's because we have to, but ultimately we don't really want to be the custodian. We'd rather partner with the bigger provider and have more fungibility across exchanges so you can move capital more efficiently. In other asset classes, you don't open up an account at NASDAQ and NYSE and BATS and Direct Edge, and that it's just a huge issue for market makers to have enough capital to get a return on their money.
We have some questions.
I want to comment, but I've already taken my...
Well, I was going to come back to you, actually, Obi, on something that you said about how, the retail customer can be slightly taken advantage of sometimes. And, there is a lot of... It's not as clear-cut in the crypto world. A lot of entities call themselves exchanges, but if you think about an exchange from the financial point of view, it's a very, it's a regulated entity, and there's, an exchange means something very definite. Whereas in the crypto world, you could be dealing with what's, fundamentally maybe just a broker or, really a FX exchange service as opposed to. So I just wondered if you could, all of the panelists, could take us through the different models that exist. So, as a retail customer, you can go and basically buy crypto, you can trade crypto. Are you doing that on a centralized or decentralized exchange? Are you doing that, through a broker? I just thought it might be useful to touch on some of those different entities.
I'll just clarify first that at least for Seed is an exchange only. We don't have any trading desk and no OTC desk at all, so we're a pure exchange model. So that's one we see as one of the differentiators.
I think we're the same. We don't have any trading desks. We don't market make. We're just the exchange. But you mentioned decentralized and centralized exchange, so I think I'll just touch on that real quick. A lot of people ask, are centralized exchanges going to get separate, phased out, and decentralized exchanges are going to become the new norm? My answer to that is both will coexist, and the reason why is, in my belief, is first, centralized exchanges provide a very good service, especially to the institutional crowd. And the reason why is because the institutional crowd doesn't want to hold their crypto. They don't want that responsibility. And in a decentralized exchange, you actually have to have your own crypto. It's in your crypto wallet. So there's a lot of custodial solutions that are out there, so they'll be able to use that. But I believe that the institutional will continue to trade on a centralized exchange in the coming years. Now, for the decentralized, for say somebody like you and I who have crypto in our wallets, by the way, how many people here have crypto? All right, actually quite a few. Actually, most of you, okay? You guys, it'd be very, very great. Look, as an exchange operator, I would love nothing more for you guys to hold your assets. I don't want that responsibility. Unfortunately, it's the responsibility I have to take today. But right now, the decentralized exchange is not fast enough. It's not quick enough. The user experience is not good. I actually had one decentralized exchange that I spoke to. They said, we're down to 1 second in trading. And I thought to myself, okay, yeah, these guys don't really come from the trading world, as you know. We're down to milliseconds, or microseconds now in trading. So even 1 second, on an exchange can be a lifetime. It's better than the 13 seconds or 18 seconds I think it takes Ethereum to settle, but the point is even 1 second isn't fast enough. I think we're at least another year and a half away before you see really good decentralized exchanges that are good for the average person. But I really don't believe I see institutional trading on a decentralized exchange. I think they'll still use centralized.
Yeah, and maybe I can add some more color in terms of, so, we talk about exchange and, what the differences are with all the different kind of models. So we provide OTC liquidity, B2B. So how is that different from an exchange? So there's a few things. One is, we actually generate our pricing. We generate a mid from based on all the aggregate exchanges that we see, and we provide a consistent liquidity to our clients. Our trades are post-trade settlement, so you don't need to post your cash or your coin in order to trade. And there's no fees involved. And these are kind of like the appeals of the OTC market versus exchange, where there's also pros and cons on both sides. But in terms of a model, this is the kind of the model that we work on our side.
Yeah, just listing different types. There are many different ways of buying or selling or taking a position in cryptocurrency. As an exchange, we don't market make as well. We have market makers or traders who act like market makers. We have an OTC, we have 2 OTC desks as well for both our UK operation and our Gibraltar operation. If people want to trade in the first European regulated OTC desk or exchange, they would use the Gibraltar offering. If they want to trade on the longest established exchange in the UK, they would use the UK offering. Other than that, there are many of our customers are brokers, so they effectively trade directly with the customer, and they have multiple customers, handle the relationship with that customer. As long as we're comfortable with what they're doing and vet them, they effectively pool all of that liquidity and volume, and we just see one trade on our side. It could be something known as straight-through processing, which is where whenever an order comes through, they back-to-back, or it could be they just take some risk and take a position and just cover the delta between buys and sells over a period of time. Those are some of the key models, and obviously we have decentralized exchanges as well, and they work in a number of different ways. Some where you have to hold capital, some where you post capital into some sort of smart contract, so the network itself is holding the capital, and some where they're not really decentralized, but they say they are.
Yeah, there's a hybrid model, isn't there, that's developing.
Also known as the hybrid.
Did you have something else? No. Okay, I don't know if we have some questions. Jonathan just alerted me to, but before we do that, maybe just quickly we can talk about the types of products that that you do represent. So it's like crypto to fiat, crypto, derivatives, just quickly so the audience has a good feel for what you do. Philip, I don't know.
Yeah, sure. So, going back to what I just mentioned, so we're focused on LTC, B2B liquidity provision. In terms of the product, we focus on the main coins, so BTC, Ethereum, Litecoin, Ripple, and BCH. And in terms of how, and also in spot and then CFDs. So CFDs, the derivative products that we offer to our clients, which what we've done is we calculated the funding costs derived from the market. And this is, it should be the norm, but it's still, crypto is still a new asset class. So I've noticed that, sometimes the funding cost is hard to come up with, but we have you receive positive funding and negative funding depending on what the market conditions are and what positions you have. Again, one of the focuses that we have is we're focused on electronic solution. So what that means is, we're focused on, it was mentioned, fixed integration, REST API, WebSocket, and then being able to trade on a GUI. But again, we're not focused on B2C, retail, and we're focused on more B2B liquidity provision.
So, as an exchange, we focus primarily on fiat to crypto transfers. On the exchange, we currently do Bitcoin and Bitcoin Cash, and we may be pausing Bitcoin Cash for a while, given the upcoming fork. And we will be adding more crypto soon. As an exchange, we're very conservative in terms of the currencies we deal with. On an OTC basis, we're very similar to B2C2. We also support Ripple, Ethereum, etc.
So we're a crypto and fiat exchange. We do, I guess you could say, the big four, big five: Bitcoin, Bitcoin Cash, Ethereum, Litecoin, Ripple, or XRP, sorry. And then we have a number of other tokens out there. For example, some of the big ones, we like Stellar, EOS, a few of the ones that we think that are good blockchain projects, and then a few other ones that you might not have heard yet, which I actually can't announce yet because that's hasn't been PR'd yet. Because again, it's for us, we feel it's kind of our responsibility as an exchange, as sort of the gatekeeper to the token world to provide good blockchain projects. It's almost, we don't trade it, but we can control what gets onto the exchange. So we want to be careful about what we put on there ourselves. And we also offer connections to the exchange, whether it's through an API or brokers can connect to the exchange to offer their liquidity. We also have a license to do custody service, so we have an institutional grade custody solution for whether you're an individual and you want to leave your assets with us, or you're an institution and want to leave them with us.
Yeah, and for us on the spot side, we'll be starting with Bitcoin, Bitcoin Cash, Litecoin, and Ethereum. We'll expand coins over time, all fiat to crypto. To start, dollar denominated to start, but we'll add pound and JPY if there's demand. On the kind of security token side, we're doing a FINRA application right now. We won't do any of that until that comes through. That'll take some time, probably Q2 of next year. And then on the derivative side, we'll start with Bitcoin and then hopefully move into the Ether, Litecoin, and Bitcoin Cash, depending on CFTC approval.
Okay, so Jonathan, if you could pull up the questions we've had so far. So the first one is, how much leverage is too much for retail? Anyone want to take that?
Theo, I knew you'd ask that question.
I'll comment just a little bit more. Look, I kind of spent, for those of you who know me out there, I spent 9 years in the retail FX industry. I was CEO of some of the largest FX brokers out there. And the whole business model is all about leverage, and you deposit $2,000 with us, we were pretty much guaranteed to get probably $2,000 from you. Working on the exchange model is very, very different. We don't offer any leverage at all. It's on a one-to-one basis. You have to have the cash to get it. It's a deliverable product. So look, there's enough volatility in the pricing itself for the retail side. So I think, if you want to get into the leverage side of it, I'd highly advise against it.
Anyone else want to comment?
Interesting for retail. Not really. Yeah, institutional is different for retail. For our futures offering, we offer a level of leverage, but it's only focused on institutional, not for retail at all. I think, and it actually relates to a point from earlier in the conversation, I do think that history is going to repeat itself. So ultimately, right now, you have to sort of be a jack of all trades. You have to be an exchange, but you have to be a custodian. And if you're offering leverage, you have to effectively calculate risk and handle leverage as well. I think because it makes sense to specialize, you're going to see those different roles split, and leverage will, in time, not be provided by the exchange or trading platform, whatever you call it. They'll be provided as one of the suite of services provided by an organization which will look not too dissimilar from some sort of crypto clearinghouse. And then you're going to have custodians. Now, we have a 100%, just preempting the next question, we have a 100% multi-signature cold storage policy. We've had it for 5 years, and it's something that's unique to the space. A lot of people say they have a 98% cold storage policy, but that still means that a very large amount of capital is at risk if you're doing something like that. And so it's very hard to have a 100% storage policy, but we've had it because we believe it's possible to do, so we should do it. But as such, I'd imagine in the fullness of time, an offering like that would be interesting to these crypto clearinghouses as they come about, if they want to use that. But ultimately, right now, it's all handled by your own exchange.
I just want to add on the safety of funds, because I know this is a pretty big issue out there, but I think people should understand something. Most of the hacks that happened wasn't because technology failed, it was because it was procedures that failed. The best analogy that I can give is, everybody is banking, right? If you walk into your bank and you go to the teller and there's thousands of dollars bills just laying on the ground right next to her, you probably wouldn't bank there, right? Because it's easy, somebody could come in and steal it. So when these exchanges out there just left tons of money sitting in these hot wallets, right? It's no different than them just leaving all this money sitting there ready for somebody to grab, right? So I think, this is why regulation is important, because regulation forces you to have the proper procedures in place. So, you know, you're starting to see things get cut down, but when you look at the exchanges that are still being hacked out there today, it's not because of a technology failure, mostly. It's mainly because of a procedural. So just to be clear on that.
Yeah, and I did have a question that I'm going to ask about regulation. You brought it up, Dan. You know, all of you have really talked about how you are all regulated and, you know, you operate sort of correctly. Where do you see the regulators focusing, and how do you see that changing going forward?
Well, I mean, maybe I could talk about going back to, I mean, FCA is one, but, you know, another one is FSA, right? FSA, again, after a massive hack, I mean, I think this is a challenging year for the regulators. You know, what do you do? And at the end of the day, what they came back with was that they're still going to allow, you know, the crypto trading to exist in the Japanese market, but it's going to be in a completely different kind of rule set. So they basically required a lot of the counterparties involved in crypto in Japan to increase their headcounts, to make sure that they hire people in from traditional finance, to, you know, I mean, the rules and the amount of stuff that they've actually put in place are immense. And they've put in a lot of effort into this, because ever since the hack happened in January until now, you know, no one's have been able to get a license since. So we think that in a very near future, there are going to be firms that are going to start getting licensing again, but it's going to be a completely different game now, and a completely different kind of type of institutions that are going to be involved. And this is a good evolution, I think, in the crypto space, because now you have some serious players coming in, and, you know, it's part of the evolution of a maturing product.
So we're regulated in Gibraltar now, but the fight to get regulation into the market has been started before we even launched, so it's approaching 6 years now. We've been fortunate enough to have conversations with Bank of England, HMT, FCA, GFSC, just name a regulatory body. We've had extensive talks with them. As a result, my current view is the following. I think, one, regulation is going to take time, and regulation always follows innovation. But the focus historically of the last few years has been around KYC, AML, that regulation related to that. I think that is now coming in, and the focus is going to start to change to two other things. One is custody, and there's going to be a lot, and you're starting to see moves in that space. I know the FCA, for example, is trying to do something quite extensive over that over the next 12 months. And the other is market manipulation, because we've seen the effect of market manipulation, and as was said earlier, we're seeing different exchanges go to the top of the rankings and then disappear, and there's a lot of suspicion around market manipulation. So again, regulators are waking up to that fact, and they're going to really try to take a handle on that. Again, because of the speed that they work, my guess is that it will take a couple of years or more, just based on our last 5 years' experience and the level that they are at this point in time.
I think the number one thing regulators have been focused on recently is KYC, and quite frankly, that's the easiest thing to do, because there's so many solutions in the market that are out there. I think even if you go upstairs, there's probably 4 or 5 of them right up there being able to do that. The harder part, that when we speak to the regulatory bodies or any of the alphabet soups that are out there, is the AML is one of their most concerned, because they want to know whether the crypto came from the dark world or the dark net, and you know, it's hard to track that. That's been probably their number one thing. How are you going to manage that this didn't come from drug money? How did you manage this? And there's some interesting solutions that are starting to solve this issue and solve this problem out there. But I think, as was just recently pointed out, what I see is going to start happening is, yes, we have fake volumes in this business. Like, there's fake news out there. Our biggest industry, black eye, is probably fake volumes. When you're regulated, you can't do those kinds of things, okay? So there's a good thing is, when you look at, for example, Coinbase out there, and you see their volume is 250, 300 million, but their valuation is 8 billion, and then you see somebody like the number one exchange out there, I don't want to put I don't want to talk bad about anyone, but the number one exchange that week might be out there, and they're doing 3, 4, 5, 7 times more, and their valuation is maybe 20% of that. it kind of shows there's something is off, right? So, you know, the one thing I do want to say is one of the reasons we partnered with NASDAQ was because their matching engine, and they are a regulated entity. They're not allowed to do those things. Their partners aren't allowed to do those things, and their partner had to be regulated, meaning we had to be regulated to do that. So this is why I think this is great for the industry to have, you know, people like ourselves or my colleagues that are on this floor to be out there more in the front so that we can get rid of this fake volume that's out there. There was another point out there I wanted to make, but I can't quite remember it, so go ahead and I'll jump in a second.
I guess I'll just comment briefly on the U.S. side. I think the CFTC has learned a ton over the last year. I think that the diligence they put into new products now is probably even more than they did a year ago with the CME, as they've understood more. So I think they're just being cautious, and I wouldn't advise like guessing on when they'll approve more tokens. And just to kind of jump in the STO side, I think the SEC also, I know there's a ton of projects pending with the SEC, and we see a lot of inbound projects from the STO space of people wanting to do it the right way. So there's a lot of demand, but I don't anticipate the regulators move super quickly on that clarity.
I remember, it is important. I think also one of the big things that typical brokers or trading entities must have is they must have some sort of capital requirement put up. And this is, you know, just to back, you know, your clients. I think also for the custody side, you're going to see that insurance might be actually demanded or required, at least some sort of coverage for the crypto assets to be out there. I know insurance is a bit new right now. It's very, very expensive, I can tell you that. But I think as more and more companies get involved in the whole crypto insurance space, I think that might become a requirement as well.
Okay, there's loads of questions. I've been giving the signal we have to wrap it up soon. But one of the questions that's kind of rolled off that is very interesting to me, because I get asked it a lot, and it sort of relates to this issue of the fake volumes. You know, what does the panel see as far as the comparison of retail versus institutional volumes, you know, in the market right now? So we hear that there are a lot of OTC. There's lots of been done. You know, people have said, oh, it's 2 or 3 times the amount of retail, but it's really hard. There's no way to verify that. So I don't know if you've got a feel for how much is being done.
I think if you see $3 billion in retail, it's about $3 billion in OTC today, from what I understand. Does that sound about right to you guys?
So what was that? Sorry.
Like if you see $3 billion is being traded on the retail side, OTC market is about the same. So usually
You're saying it's about
double.
the same?
Yes.
Does anyone have a different opinion?
So it's really $6 billion is being traded that day. $3 billion from retail, $3 billion from the OTC desk.
I would guess that a higher percentage of the retail trading platforms now are HFT to HFT market makers trading with each other, with retail flow going down. So when you see $3 billion, it's probably, I would guess, a lower percentage of actual retail participants than maybe it was.
Oh yeah, that includes the fake volume.
Yeah.
Sorry, sorry, because I'm not sure what percentage is fake, but
No,
generally speaking.
I wasn't even
real
speaking to
facts.
fake, I was speaking to actual transactions. I think usually when a market, whether it's on the institutional side or retail side, when volume comes off, the market makers are still there, and their percentage of the trading goes up just by kind of definition.
Philip, do you want to weigh in, being OTC? I mean, what do you think in terms of
Yeah, I mean,
how much
that's a hard one to guess. I mean, really, the number could be anything, but I mean, I would agree maybe, in ballpark, maybe the numbers that were mentioned. That's very hard to say, so.
Is there, the question actually that was up there was what is sort of the average OTC volumes per month? I mean, that obviously you just see part of the market, but do you have any feel for that?
I mean, it really ranges. I mean, if you talk about an average this year, I mean, from the peak, I think it's dropped so significantly, right? So right now, I think it's personally, I think it's the bottom of the bear market, and you know, it's really hard to say. I would say so. It's a tough one for me to answer.
I couldn't get an answer to the one question I
Yeah.
wanted.
Yeah, it's going to be hard for you to get an answer from that, from an active
any
exchange
numbers, right?
or OTC desk. But yeah, I mean, personally, I think we're still going through the bear market. I think it's probably going to get a bit more bearish still for a good few more months, based on past experience and being around this before. But that's my personal view. But in terms of percentage, it's really hard to say an average, because if you take the last year, an average wouldn't make any sense, because the variation would be so wide.
Okay. Well, I think we're really wrapping up, so I just want to give you all a chance to maybe make a closing statement. You know, what do you see happening 2019?
I guess on the same kind of topic, I think there are a lot of hedge funds that are crypto only or hedge funds getting in the space now that aren't trading that much right now, and so the average ticket maybe is down a lot, but they're just as enthusiastic as they were 6 months ago, and they're building the infrastructure, and a lot of them are trying to build track record and raise money and build proper asset management type firms around the sector. If they have growth, then all the folks on the stage will have growth as well, and that'll drive that. But there's a lot of folks, I think, sitting on the sidelines with a lot in cash, but very dedicated to the space, and that'll be a very important driver for next year for the institutional side.
As an exchange, we don't make predictions, so I'll stay politically correct there. But you know what, Theo, who's Theo? Hey, Theo, I thought so. You're on fire. I'll answer your question, though. I think there's a platform called, is it Ledger X that's out there that does do options is it swaps? I thought there might, anyways, I think that's the closest thing out there right now to option. I think it's a great thing to have, and it's something DX will be looking at in 2019, because I think a lot of institutions also use options to hedge their positions as well, and I think it's a better option than what's out there today by trading on, say, for example, BitMEX or something like that. But definitely, I think I see options coming into the 2019 for sure.
I think 2019 is going to continue to be a very competitive year, for longer than most people will imagine. I think you're going to see regulation actually come in, especially in Europe. You've got Fifth Money Laundering Directive that has to happen before the end of 2019. I think it's going to be important for people to just partner with organizations who are going to be ready for the fight and who have that experience. And that's what's going to be key for 2019.
And my take is, just taking a step back to 2017, which was a phenomenal year. I think that was the year when it went mainstream. And the reason I say that is I was at Goldman, and that was the first time that all the senior managing directors were saying, do we need to start market making crypto? So it really caught a lot of people's attention. So what was 2018? Was 2017 wrong? Just came, and we entered a bear market. I really do think 2018 is this gradual evolution and transition. You're kind of creating this baseline. You're creating this KYC ML processes, improving the infrastructure and everything. So I think that's what 2018 is. 2019, personally, I think that there's just so much other factors going on in other traditional asset classes. Interest rate in the U.S. is going up, EM is looking shaky, equity market is looking shaky. And maybe this isn't my personal hope, but I do think that the attention is going to shift back to crypto. And this time, the story isn't just going to be some bubble led by retail. There's going to be some cases made for digital gold. There's going to be cases made for, a proper asset class, which belongs along with all the other traditional asset class. But that's my own strong personal opinion. So.
That's a great way to end the panel. I think we could have gone on for hours, so we'll stop it there. But thank you, Sam, Dan, Obi, and Philippe. Really good conversation.